What this has done is drained far too much paper, gold and silver naked short positions into the real deliverable exchanges. They're not deliverable. And this is where the rubber meets the road.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Welcome to Live from the Vault. My name is Shane Morand, and I'll be your host for this episode. And from the entire Live from the Vault team worldwide, we want to thank you for your continued support. And as you can imagine, this community keeps growing thanks to you, our Live from the Vault community. And there's a lot to talk about during these historic times. And fear not, because we have the one and only Andrew Maguire in the house, and we'll be talking gold. This is going to be an amazing episode, so fasten your seatbelts. You know, Live from the Vault gives you access to information and updates that you just can't get anywhere else, and this episode is no exception. And with that, let's head over to the UK and talking gold with Andrew Maguire. Now, Andrew, can we start off with a summary of the action since our last market update on the 19th of October, where we kept the focus on the very large disconnect between the Comex market makers and who are betting long, and you've got the speculators on the other side betting short. Can you bring us up to date on what's happening there?
Yes, Shane, great to see you again. And we all know the house always wins. So let's start by looking at this ballooning, unsustainable condition, and then what we expect now that we have experienced now that we've finished October and we've started November trade. Now, we're recording this on Tuesday, the 1st of November. Now, with October trade having moved into the rearview mirror yesterday, which is, as I say, Monday the 31st, we'll take a look at the underbelly of the market so as to best to assess going forward what we would expect into this month's very large December options expiry on the 22nd of November, and that's ahead of the US Thanksgiving holiday on the 24th of November. Now, in between, we've actually got the US midterm elections next week on the 8th of November. Now, given the House's rigged inverse correlation in Comex paper, gold and silver, where the speculators have been led by the nose to place naked short bets against the House into a rising dollar. And bear in mind, the dollar has risen to 20-year highs. Now, we talked about this last time. Basically, it's just an inverse correlation. So dollar rises and they sell gold and silver, naked short though. And as the dollar falls, they tend to cover. And these are neutral algos, but as we talked last time, the HFT bots, the big bots that the House controls, leads these what are normally neutral algos by the nose. And it's the House game this is the House game that's been the primary driver that has really powered these spec algos to one-to-one sell gold and silver against each tick of the dollar higher. And of course, it's risen to a 20-year high. But, and this is a big but, the approaching uncertainty into the midterms really ought to evidence some renewed dollar profit-taking and weakness into uncertainty so as to price the possibility that the Democrats lose control of Congress on November the 8th. Now, given the paper-centric gold and silver action has been driven by the speculative herd tick for tick, naked short selling gold and silver futures contracts into this rising dollar, a resumption of dollar weakness will remove, this is the key point, this inversely correlated dollar, gold, silver bid pulling tool that has really severely wrong-footed specs over the last 7 months. Now, without this tool to suck in more naked short spec supply, it'll spark the House to ring the register on these very large undeliverable naked short spec bets, which are in gold and silver. And they've accrued over the last 7 months. And if you recall, this wall of paper, gold and silver selling operation into what was an inversely strong race to safe haven physical gold and silver, by no coincidence commenced directly after the Russia-Ukraine military operation in March. And we looked in close detail at this at the time and subsequently. Now, given the Russian central bank opened up a physical gold buying operation to coincide with their military operation in Ukraine, the US then instigated a very obvious, officially sanctioned PsyOps paper sell operation, which we had warned was going to create a massive divide between the paper and real physical market, which really by now has in its current form effectively destroyed the Comex as a global price-setting operation. And this is where we are right now. So, I mean, it has to be understood, in cyberspace, we see social media has enabled the use of disinformation on a wide scale. Anyone doubting that the governmental employment of psychological operations to influence the mainstream media and the management of hegemony in the financial markets, please just look it up on Wikipedia. It explains it reasonably well. And we've been tracking this PsyOps operation closely over the last 7 months. And we see that this operation to create and sell paper, gold and silver has misled the captive hedge fund herd, siloed inside the walls of the Comex casino. But, and again, this is a huge but, this synthetic sell action has now drained so much liquidity out of the casino through the EFP Achilles heel. And don't forget, the EFP is simply a mechanism to convert paper gold from the Comex into liverable physical gold in London. So what this has done is drained far too much paper, gold and silver naked short positions into the real deliverable exchanges. They're not deliverable. And this is where the rubber meets the road, which means that unless these massive undeliverable paper, gold and silver positions are squared up, the Comex will be drained of completely of the tiny fraction of bullion that underpins each ounce borrowed and then speculatively sold.
Hey, Andrew, can you share with our audience here the scale of these EFP outflows?
Yeah, Shane, just to give an idea of the volumes flowing through this EFP mechanism, just in October alone, we have evidenced, this will mean a lot to traders, 56,591 gold futures contract EFP'd. That is a staggering 176 tons of gold. Just imagine, really 176 tons of gold, but outflowing by paper into the over-the-counter markets. And in silver, 15,423 costs. I mean, that's a ludicrous 2,400 tons of silver. Now, clearly, some of these outflows have been squared off in both the GLD and SLV ETFs. You know, the illusion, these illusionary exchanges where you can actually have unallocated gold and silver flowing in and out of these exchanges. And we have to rely on the fact that the insiders are actually allocating that into physical. But we've had multiple instances over the years where we have proved 100% that they have been unable to do so. And so what happens is these flows, sometimes they can be squared in unallocated form, is what we're saying. But nevertheless, regardless, this outflow of paper market liquidity that we are tracking is leaving what is left in the casino backed by less and less physical. And as is always the case into geopolitical events, this sanctioned PsyOps operation was designed to swamp the natural unleveraged safe haven moves into physical gold by generating this wall of leveraged paper gold supply. But as we've warned, this is going to blow back on the speculators who have really been tricked into holding this debt. And who's the creditor to this debt? Yes, of course, it's the house. Into this 7-month period of counterintuitive selling, ETF gold has slumped to, and we're talking about GLD, etc., has slumped to a 30-month low of 2,900 tons, as speculative longs have capitulated their paper gold positions, sending it really essentially on a one-way trip to feed the house market makers, and who are forced to fill Basel III compliant spot gold positions into a starved for physical supply global market. So you've got two things going on here. You've got the insiders and you've got the officials. Now, we've covered the implementation of these Basel III NSFRs, which net stable funding ratios, which force the over-the-counter spot market liquidity providers outside the casino to back this liquidity provision with physical gold. We've tracked that in the past, but really the evidence of that, the Bank of International Settlements, which is the central bank of all banks, brought in this provision to force. They forced it into the banks after the March 2020 EFP mechanism blew up, coming close to bringing down the entire paper market deck of cards. Now, if you remember, we covered that really, go back to March 2020 and April and May and June. We were talking about this scramble there to try and recover what was really the banks on the precipice of failing. And while this officially driven PsyOps operation was assisted by safe haven foreign exchange market moves into the dollar, so in other words, we saw the dollar rising, so therefore there was the excuse to sell gold and silver, the resulting unnatural precious metals condition has broken the Comex relationship with the global wholesale physical markets, opening a huge price and supply demand chasm between the paper and the physical markets. This is what we've been tracking so closely for many months now. And as we've discussed in our last episode, those resulting extremely large physical premiums over spot to obtain bullion for immediate delivery have not been evident since 2008, when we saw the 2008 enormous rally in gold and silver. And if you remember, that was following the Lehman collapse. And even though it's being glossed over by the mainstream media right now, the race to protect even larger, rehypothecated Credit Suisse delivery positions, large enough to implode the daisy chain of around $2 quadrillion of interconnected interbank derivative risk, it's all interconnected, is clearly being ignored by the news services. Now, probably with what is called a DSMA order, which is, we've seen that before, usually for terrorist adventures, but it's a Defense and Security Media Advisory Notice, which is used from time to time because it is a security matter. Because every liquidity provider we've spoken to is busy hedging this massive tail risk. That's why we know there has to be some kind of DSMA order here. I would ask you to look at what happened in the tiny, in comparison, nickel markets and multiply that by 10,000 times the risk. This time, it's not going to be contained inside the tiny ring-fenced LME. Now, clearly, they're going to try and not this to happen and let this happen. And so it means essentially the price has got to rise. But guess what liquidity providers are doing to hedge this tail risk? And yeah, of course, you've guessed it, physically buying the very same underlying physical commodities that these derivatives leverage. And they can see it happening in essentially in all the commodity markets. Now, and we're talking about every single physical commodity is stealthily being accumulated with depreciating dollars, yen, euros, etc., yuan, rubles, and the most fungible, actually not rubles because it's strong, and the most fungible of these commodities is physical gold. Fungibility is the key here. Strip away the smoke and mirrors illusion the US paper markets generate and ask yourself the question, why every single central bank without exception, including the central bank of central banks, are securing physical gold into this paper to physical imbalance. So the resulting physical gold shortages are being reported in every single jurisdiction, including Russia and China. So given only the blinkered specs hold the accrued undeliverable short positions against the house, where does the rubber meet the road on these divergent oversold paper market conditions is the question that we obviously get and that is often raised in our liquidity provider meetings. So to sum it up, a closer look at the underbelly of the market reveals where, after 7 months of tricked in spec short selling, The game spec neutral positions are aggregated. What we're going to see is where are they actually aggregated after the house rings the register on them. The register will be run on these guys. And it's just really a question of when. And we think we're going to give you an idea about that in a minute. But given the undeliverability of these spec held short bets against the house, at best estimate, the neutral spec sweet spot, i.e. where they will have covered all their naked short bets before taking on any fresh naked longs, they will become magnetic once insiders turn upon the Comex for physical delivery. And really, that's what is beginning to happen. And they're obviously being forced to pull the trigger to ring the register. They will be forced to ring the register while they're still afforded the opportunity to do so, i.e. to settle some of these naked short bets with naked longs. And the spec neutral sweet spot are around really the gap closes into the March 2000 gold futures level and the 26s in silver futures. These are the synthetic sell points. And we'll look at that in more detail shortly. But given the house run high frequency trading bots are geared to directly influence the otherwise neutral spec run algos, and of case, inversely correlating, leading them by the nose to tick for tick sell freshly created naked short undeliverable paper gold and silver bets against the dollar, which of course hit 20-year highs. And so really, if any upcoming fresh weakness in the dollar index would provide a helpful tailwind to trigger this gap close.
Andrew, you'd been discussing just how broken the paper silver market has become, and now you're confirming the global buyers are turning to the Comex for actual delivery. Can you share with our viewers about this?
Yes, Shane. Comex silver is now being turned on for delivery by our European staffed wholesalers. And this has just happened literally in the last week. Happy now to pay just the 10, 12 cents shipping costs to drain the Comex silver warehouses of registered silver. The problem for the house is there is far too little registered silver to be physically delivered outside the warehouse doors and loaded out, in other words, delivered. In other words, Comex registered silver it's rehypothecated, which historically has never been a problem for the insiders controlling the game, as they could really bank on these margin specs who've borrowed these positions to never take delivery. Yeah, but the price is making it attractive for others to do so. And having dislocated the price too far, Comex has come into the crosshairs for delivery, which will force market makers holding eligible silver, which is not really for sale. This is just silver being held in the same warehouses where the registered silver is being basically leveraged. We're going to force them to convert these otherwise undeliverable bullion holdings into the registered category. And this is going to cause a big silver short squeeze, structurally very similar, to what we saw in 2008. So while this hedge fund herd races from pillar to post, they have this learned muscle memory, and it's still being perpetuated. You can see it today on a bit of news. Some very obvious insider market-making bid polling efforts are really the trigger for this. And they're not adding shorts. Global buyers are increasingly turning to the Comex to obtain physical supply. And with registered Comex inventories extremely thin and extremely rehypothecated, the move to EFP, Comex registered inventories for physical delivery, is ultimately what will trigger insiders to start to ring the register on these massively underwater spec positions. So really, looking at the options footprints, we're very, very close here.
Andrew, can you expand a little bit on what these magnetic option footprints reveal?
Yes, absolutely, Shane. And the reason we need to focus on monthly options expiries is it helps us to weigh up the extent of the paper price disconnect, and it provides us with a rolling view of the pit managers, otherwise very masked footprints into the deliberately opaque smoke and mirrors world of the Comex. And we will look at the structural similarities in a sec, but let's look at what we're seeing right now. And as we highlighted in our last episode, we've proved without a shadow of a doubt that at the end of each day, the CME's transaction data is deliberately being withheld by the house insiders to specifically provide them a tool to wrongfoot the spec herd they prey upon. Just reference our last episode, please, where we proved that the previously available TOCOM data, the Tokyo Commodity Exchange data, evidenced exactly the same Comex actors' footprints and how they were positioning long or short. That was until the CME lobbied TOCOM to withhold this data. If you remember, we talked about that in detail. It proves the point. It is available. In order to best assess the footprints, though, we have to then connect the dots ourselves. And a view into the wholesale markets helps us to expose the concurrent house footprints into the unreported 10 times larger connected delivery markets to best assess what degree the controlling house is positioning long or short against the specs. And bearing in mind that Basel III NSFR conditions make this a lot easier to discern in gold versus silver, which is not NSFR compliant. And Basel III compliant over-the-counter spot gold, and of course also non-NSFR compliant silver, delivery markets are deliberately made unavailable to the US-centric hedge fund herd. But the option structure does provide us this rolling monthly view of a divergence into these deliberately obscured Comex footprints. And just like the specs were set up by the house in September, our take is that following the rising dollar index since then, the gold and silver smackdown into the end of October really was about the bottom. The house is set up for an upside rinse into the December contract expiry this November, which is the 22nd. In summary, though, the house-run HFT bots that directionally lead the otherwise neutral spec algos by the nose to inversely correlate this rising dollar index to the gold and silver, naked short sell orders, you're going to get bored with this, but it's true, have been capitulating and really are beginning to capitulate. And really, the rise of the dollar index into the 20-year highs by tricking the hedge fund herd into selling gold futures has really been on the other side of that picture. What we're saying is the house has been taking the long position against them, paper to paper, and that's what they're trying to cover before the Comex, the outside global markets come to the Comex, which they're increasingly doing to take what's being offered. And while the house is one-to-one hedged against the specs, there is some open interest bleed into the delivery markets as a physical starved global market turns to the Comex to capitalize on the gold on offer that is ultimately setting the spot price in the global markets. The first thing we have to do to assess where the price is going is to look at the upcoming December option structure, which due to the Thanksgiving holiday on the 24th of November will, as I say, expire 3 days earlier than usual on the 22nd. Usually we see a full week into first notice day on the 29th. Now, this is likely where the trigger is pulled, and that's the point I'm trying to make here. The December contract is the largest delivery contract of the year and the only contract where both gold and silver futures expire together. It is also the culmination of forward bets made a year ago, and with the specs extremely wrong-footed, they're deep below the anticipated house sweet spots here. And looking at the footprints leading into the December structure, we only have to go back as far as September the 28th, October options expiry, which was in September, where we evidenced the specs in an unprecedentedly wrong foot naked short structural position against the house. And this led to the anticipated disruptive upside air pockets. We saw it rise. And the house was ringing the register on them, but then we had some subsequent dollar strength and the same specs were led right back into a similar setup for October. However, silver never made any fresh lows. In fact, it was making a series of higher lows. Why? Because there's no silver there. And looking deeper into this December structure, accounting for the outflow of open interest, we're looking at gold at 2100 is about the equilibrium point that would wash out the spec shorts and put the plain vanilla house to spec structure back to neutral. And it would take fresh bets above 2100 to evidence, the same naked short specs to begin to add naked long positions, which is not what we ever want to see. And this is a structural parallel that we evidenced in October 2008, ahead of a similar physically driven short squeeze. Furthermore, this is what the January OPEX structure, which goes into expiry, as I say, on December the 27th, actually the January OPEX structure, does separate that, expires on December the 27th. It indicates this, and it really, what it is doing is uncovering extremely large spec bets against the house from 2000 to 2400. So really, this looks like a very attractive move. And in summary, really what we're saying is, I'm not alone in saying this. If you remember, Andy Sheckman raised this in our last episode. The current global race into safe haven gold and silver mirrors what we evidenced between October 2008 with gold at $680, commencing a $1,240 3-year rally into the 30th of September 2011. And the pullbacks were just barely buyable. It was a race into safe havens. And this was a period when the safe haven dollar strength was actually, on a net basis, concurrent with gold strength. The dollar and gold can rise together. And a similar look at the January silver options bets, again, September, which is the January one, which is December the 27th, evidences specs really betting large against $26 through $30, which at $26 would restore an equilibrium price. But with such a dislocated paper to physical structure, the large short bets at 30 could easily become magnetic at this point. So as far as silver is concerned, the massive over-leveraged over-the-counter silver derivative position that backs up the underwater SLV short that has to be unwound before then, if you remember we talked about it last time, hence the officially sanctioned race by insiders to cover as many of these SLV shorts is underway. And this is undoubtedly the reason for this sinister silver action that we've been drawing attention to. The efforts to cover SLV shorts are really hampered by the large EFP demands trying to address vapor-thin physical supply. Now we've got the European wholesalers coming in to say, give it to me. And the insider-run HFT algos are really targeting every ounce they can from naked short specs because they want to cover paper to paper before it becomes a physical loadout. If it's a physical loadout, they want a higher price, which has now driven the largest physical to paper disconnect again since 2008. Silver futures were at $8.50. They were $8.50, which ultimately sparked a $40 move into 1st of May 2011. So really, bottom line, the action in SI is a farce, but it reflects insiders scrambling to cover SLV shorts into the spec sellers. And given the earlier noted OPEX structure into the largest delivery month of the year, we expect the spec rinse to commence early next month, likely maybe after non-farm payrolls this month even. The only question is, guys, how much physical gold and silver do you own?
All right, there you have it. Thank you, Andrew Maguire, talking gold. And remember, to our Live from the Vault community, buy physical and make sure it's one-to-one physical. And understand the difference between what Andy affectionately calls the casino paper gold and silver markets and the actual physical gold and silver markets. They're not the same. Don't be fooled. And there you have it. That's all we have for you today on another fascinating episode of Live from the Vault. Please help spread the word about this channel by hitting that like button, by sharing, by subscribing, and click on the bell right there if you'd like to be notified as each episode goes live. And with that, We'll see you next time right here on Live from the Vault. See you then.